Welcome to my channel. I'm Dr. Romano. In today's video, I'm going to talk about how Bernie Madoff changed the hedge fund industry. And at that particular time, what was his success in raising capital? How did he create such a big company so fast, etc. And I'm also going to discuss with you the downfall of the typical investor. Just because some people become very wealthy on whatever they know to make money, that doesn't mean that they're capable of investing those assets. And that's what led to the rise of Bernie Madoff. That also led rise to Sam Bankman-Fried and many other people that we don't talk about in our society because it's not publicized. Before we continue the video, please remember to do thumbs up and subscribe. It's right there. All you have to do is press that button. But by pressing that subscribe button and thumbs up, that really will help me out. Thank you so much. Bernie Madoff started in the early 50s and 60s, and he started off quite successful. He created a company as a market maker on the New York Stock Exchange. He was in the Lipstick Building in Manhattan. And I used to work only blocks away from the Lipstick Building while I was a commercial real estate broker. And there's been a number of times that I seen him at Le Cirque, a number of times I seen him walking in the street, and a number of times I always wondered, how did he become so successful? Now, he was successful in raising capital and creating a mirage, but he actually never traded anyone's capital. That's the misconception that most people have. He never traded people's capital. He was running, as we all know, a Ponzi scheme. So he started, somehow his relative had an accounting firm, and the partner and the relative were sending clients to Bernie to invest money. And at the time, what they were doing is they were becoming the hedge fund, but it wasn't a legitimate company. It wasn't filed legitimately, and he kept avoiding to file. And I'm going to explain how that happened. And so as he kept raising capital, since he was a guru at raising capital, he was paying out dividends to the other investors. So as he would raise more capital, he would give that out to the previous investors to look as if he was actually creating investments, etc. And the most important thing in this story is that he actually made people believe that he was capable of investing your assets. Now this is very, very important because yes, he was a salesman, and it happens to be that really good salesmen have a dominant quality about them. And so Bernie Madoff was known as a bully in that perspective. And he would bully his clients not to ask questions, or not to ask questions that he didn't want to answer. And this is very, very important because this is basically what led to his success during my PhD research, because my PhD was hedge fund selection. I wanted to become a specialist of hedge fund selection so that I could create my own funds of funds. And that's what led me all this way to create a PhD and continue to do research. Because the fact is that just because you're a CEO or you're an owner of a business, you're capable of making money in what you're good at. But it doesn't mean that once you've made this money, you're good at also investing in it. Whereas Warren Buffett, he's really good at investing the capital and creating the wealth, but he's incapable of spending it and enjoying his life. You know, if you want to raise capital for a hedge fund, whatever it is, you need to be in the right area at the right time. And what do I mean by that? Well, he had a house in Palm Beach, Florida, and that particular society back then, they were the same background as Bernie, a lot of them. And what's really interesting is because he resonated with their background, because he also had that background, that a lot of people just threw money at him and invested in his company with trust because he had the same background as they did. And he resonated with a lot of successful people, because very successful people, I'm not saying they're all bullies, but you could guarantee you they have a dominant quality about them. They know how to persuade the person that they're in front of not to ask certain questions, or to answer it in a way that they'll never ask it again. And this is what Bernie Madoff was really good at, because there were a number of questions that a savvy investor would ask him, and basically he would throw them under the carpet. He would get them really scared. And he was called a bully for this reason. And this is another reason why you should never ever invest in a hedge fund manager with the ideology that you're going to meet that person and you're going to make a decision whether or not you want to invest in that hedge fund or that funds of funds. You should already have a plan and blueprints in your methodology on selecting and deselecting hedge funds for your portfolio. Whether it's 10 billion, 100 billion, or 5 million, it doesn't matter what that is, that number, but you need to have that plan, and you need to make a visual image on what each hedge fund you want them to look like based on their returns. Because the fact is that just because someone goes to Harvard, like Ken Griffin, that doesn't mean that he's qualified, and then the other people that don't go to Harvard aren't qualified. The fact is that Ray Dalio went to my university, Long Island University, and Ray Dalio has $180 billion under AUM approximately. And of course, Ken Griffin is growing. Point is that looking and asking someone like a hedge fund manager, where did you go to school? Well, I understand that you're not a professional hedge fund selection specialist. And I also know that you're not a racist. But then why would you ask someone where they went to school? That's kind of already answering the question whether or not you're going to invest in them. The sad thing is that the collapse of 2008 and 2009 in our investment banking industry, a lot of those people, those young kids, so to speak, in their 20s and 30s who are managing those assets, you don't realize this, how young they were. But how does a trader start? Well, they either get recruited from an Ivy League school, they become an assistant trader, and then approximately at 2.5 years or so, they are lucky to become a trader. Then they last about 2 years as a trader, and then the company repeats the cycle. Some of them are good, some of them are not. And then you have the other people who may not go to an Ivy League school, or that maybe they have, and they get hired through their best friend. Now, I was hired through my best friend to work in the chief financial office in risk management. I was a risk analyst. So I would look at the trading books. And so I had firsthand knowledge and exposure how a trading group worked and how it didn't work. And the interesting thing is that I seen a lot of errors that were taking place. Very elementary, honestly. So in other words, the investment bank will take your pension and your retirement and your savings, and they'll allow people in their mid-20s to 30s to trade it who don't even have a track record. So when you go to a hedge fund manager and you're asking that person, well, how long did you trade prior? Or you're looking at their returns and you're saying, how many years did you trade before this? Well, again, that's another elementary question, because the investment bank hires these kids to trade which don't have a track record yet. The hedge fund manager has a track record. It's a legal entity that has to be audited, has to have an independent accountant, has to have an independent administrator to make sure they're in that account, they're being invested there and here, etc. And so to answer your question, you're going to lose all your money. Not today, honestly, and I'm saying this because it's a logical answer. When you realize what happened in Bernie Madoff's case, the people didn't even care where their money was. They weren't even allowed to ask him, can I see your bank account, or can I see where the assets are? Nothing. They had no knowledge of how to select a hedge fund. Let's just confirm, Bernie Madoff did not have a hedge fund, but he marketed himself out to the industry, the investors, as if he kind of did, but he never could call it a hedge fund because he always refused to file with the SEC. He would go around the doorway to make sure he didn't have to file, because if he had to file, he wouldn't have been in business. He wouldn't have been able to raise so much capital. At one point, it was only 5 million, and it continued to grow. That was a lot of money. I'm not sure the actual amount, but in today's dollars, it was a lot of money. Of course, whether it was $1 billion or 20 billion, that's still a lot of money to have. And the fact is that the investor had no knowledge of where that money was. And for 10 years, 20 years, investors didn't question it. So again, just because an investor is capable of making the money, they're not capable of investing it. And this is the big reason, because they ask really ignorant questions. And I'm going to use the word ignorant because it's the only way I can explain this. The fact is that you're good at what you're good at, and that's it. I'm not good at everything. Unfortunately, I know what I know, and that's it. I mean, I love to read and I love to learn, but unfortunately, I'm not good at everything, but I know what I'm good at, and that's hedge fund selection. And the fact is that investors, companies, wealthy banks in Europe, wealthy connections, all these people, they had no idea really how to invest money. And those people at the banks in Europe, all over the world, in America, they were just handing their money over blindly. Let's speed it up to 2023 and let's question, well, how would you analyze a hedge fund investment? How would you go about actually selecting a hedge fund manager to manage part of your capital? Because you would never allow one person to manage all your capital, or one company. You can't be that stupid. And the fact is that a lot of these people, they had billions of dollars in Bernie Madoff's company, and he was like the only one that was managing their capital. They thought that he was managing their capital, and it was a total disgrace. Some people are really gifted at making money, like his clients, but yet they're incapable of growing that wealth besides their employment or their company that they started. And what was really interesting is that Bernie Madoff really hurt the hedge fund industry. And the hedge fund industry only started to really grow and to be a little more to grow and to allow the public to take seriousness in it is after the collapse of 08 and 09, that era. And it took around 3 years for the government, or so 3 years, to change the laws that stated that investment banks could invest in hedge funds, because the investment banks lost all that money, whereas the hedge funds did not. The legitimate hedge funds, that is. A legitimate hedge fund, what is it? Well, you make sure it's a U.S. company, you make sure that the audit company is in the U.S., and you make sure the administrator is in the U.S., because you have a much lower risk of them committing fraud. Because if the administrator is managing 100 to 200 accounts, let's say, why would they let one hedge fund slide under the carpets? Or why would the hedge fund accountant company allow one hedge fund to slide under the carpet, meaning make errors? So the likelihood is that they'll go bankrupt, okay? They'll lose their career, they'll lose their company. You could guarantee you in 2023, they are doing the best possible management and the protection of your assets. Now, I'm not saying that things won't ever happen. Of course they're going to happen. It's always because of something. Now, on Sam Bankman-Fried, I don't know how he got away with not having an administrator and a hedge fund accountant that's a separate company, that's independent company. Maybe because he was in the Cayman Islands, or maybe because he wasn't registering as a hedge fund. I don't know how that happened. That's research that I have to continue to find out. But the point is that you never invest in an industry that's new. And that's just how it is. You need to wait until there's a collapse, like now in the cryptocurrency industry. It's actually a good time, I believe, to buy Bitcoin and hold on to it for 3 years, 2 to 3 years. Based on the charts, it seems like it's taken 2 to 3 years to really escalate. And I bet it will probably go up to 80,000 this time, because it seems to get more momentum. People would ask Bernie Madoff what's a good stock tip, and he would actually tell them. And the point is that he was lying. He didn't know anything about trading. Nothing. He didn't trade at all. He didn't trade people's assets. He simply was running a Ponzi scheme, and he got away with it so much. And what's really, really sad, as he developed a certain clientele, people started to invest in him even more. And that's really scary because, again, investors are relying on their friends to give them advice. Again, Sam Bankman-Fried, he also was raising capital, and he was raising a lot of capital, 10 billion, whatever it was, because he aligned himself with the right people that would promote him. Whereas Bernie Madoff was doing the same thing. You buy a house in Palm Beach, you get invited to those charities, you have the fingertips of the wealthy people. You go to Saint-Tropez in the summer in the south of France for August, and again, you're in the center of wealth. You go to the Monaco boat show. Again, you're dealing with people who can afford a $20 million yacht to a $200 million yacht. So again, he was very gifted with really knowing where he had to be. And what's really sad is because investors at the time of Bernie Madoff, other hedge funds were marketing themselves out to the public, and the investors would say, is there any risk? Legally, the hedge fund manager has to say that there is risk. Past returns is not an indicator of future returns. That's legal jargon. As soon as the hedge fund manager would say that, there is risk in everything, the investor would walk away. Because Bernie Madoff's fake fund had no risk. According to the chart, it continued to go up. So those two computer programmers that were working for Bernie Madoff from Queens, they didn't even have a college degree in finance. They couldn't even fake what an actual investment looked like. Because if they did fake it, so to speak, if they made it where it went up and there was a pullback, it went up, there was a pullback, and tried to follow the markets, like the SPX, well, that guy who wanted to basically have the SEC audit them, that I can't remember his name, but he was very smart. He was doing a statistical analysis and creating trading strategies based on how Bernie Madoff was making money, supposedly. At that time, nobody knew it was fake. So he did come up with a strategy, and he tried to market out to people, and no one would invest in him. If they had invested in this guy that was the real trader, they would not have lost so much money. Secondly, you do not invest all your capital in one company. You wouldn't invest all your capital in one investment bank. Or you wouldn't invest all your capital in one asset, right? Again, how did these smart people who made millions lose almost half of what they had? There was a family in Palm Beach that had to sell their house because they lost $30 million in Bernie Madoff. And so their other wealth was in their real estate, and so they had to sell their $30 million Palm Beach house. Again, these people, any investment has risk. So if you're going to actually put up money and believe that there's no risk, then you shouldn't be buying an asset. You shouldn't be investing in any of that. You should actually be buying diamonds and gold coins, because that's a hard asset. No one is going to take that away from you if you create a safe deposit box and the owner of the safe deposit box is your private foundation. Does that make sense? So it's a for sure investment, because diamonds always hold value, gold coins are value. And taking half of your assets and investing it in Bernie Madoff was not something normal. And the fact is that even the people who he was paying them a return to, they had to pay all that back, all those returns. So even if they were worth $30 million, well, over a 15-year period, they were living off that return. So they had to return their actual assets to the government when they were investigating. And it was just a disgrace. I don't know what's going to happen with Sam Bankman-Fried, that fraud that he created. It's a disgrace. You should not have invested so much money. You should only take no more than 10% of your wealth. And actually, it's not 10%. You should only be investing, I would say, 60% of your wealth in different type of assets. And out of that 60%, no more than 10% in one particular asset. This way, if it does go bankrupt, if you do have an issue with the stock market or whatever it is, since you're not a hedge fund doctor like I am, you invested in the wrong hedge fund, that particular strategy is not going to make money in a stock market collapse. You should have known to select hedge funds that are capable of maxing their returns in a stock market collapse. And of course, you need to foresee that in the future in order to make and create your portfolio. So again, you're not that special doctor like I am. And this is why you need to always remember, never invest in hedge funds directly. You're not the doctor of hedge fund like I am. You invest in funds of funds. And because if you would have invested in the funds of funds business, you would still have your wealth. You wouldn't have lost it with Sam Bankman-Fried or let's say other people like Bernie Madoff, because there's always going to be someone out there that somehow gets under the radar. Because it's a fact that the people that went to audit Bernie Madoff were kids. So in other words, the SEC actually wouldn't send adults. They hired kids right out of college to investigate a gigantic fund because no one wanted to go against him. Again, things have changed since then. Things are more proficient. The laws have changed. You need to remove your fear that hedge funds are bad, because they're not. To say to yourself, oh, you're going to lose all your money. You just said that you're going to put all your money in one hedge fund. And that's not possible. So again, you're answering a really ignorant question by saying that, because a lot of people that I speak to, they may be very wealthy, like the owner of a real estate company that's global. He had mentioned, oh, I would never invest in hedge funds. That's not for me. Thank you so much for watching my video. Please remember to subscribe to my channel and do thumbs up. It's right there. If you click those two buttons, that will really help me out. Thank you so much.